So, one of the main questions I'm getting from people regularly is what should I do with my investment accounts when the market goes down? Well, two simple answers. Number one is always have 6 months worth of emergency funds sitting in a bank account that's not on the market. You want to research high yield savings accounts. Go ahead and type that in your phone right now. See what comes up. One of my favorite websites is nerdwallet.com. Nerdwallet keeps up with banks consistently, shows you who the top paying interest bearing accounts are, what they are, and who they are, and the ones that are FDIC insured. So you'll notice that that list changes from time to time, but there are various banks that stay on that list. It makes absolutely no sense to save money and the bank is only paying you 1% interest and they're charging you fees for transferring, fees for overdraft, fees, monthly fees just for maintaining an account, fees for ATMs. Your money is depreciating in value quickly sitting in the bank because not only just because of the fees, but because of the cost of living increase. The last time I gave a workshop, the cost of living was going up by 5%. But since we've had tariffs, the cost of living inflation has hit 8, 9, and 10%. That means that my son just last week went to buy a basketball at one of those sporting goods places, and the basketball cost $50, where the week before the basketball was between $15 and $25. You all understand what's happening. So the cost of living is going up exponentially. And if your money is sitting in the bank and it's only getting 2, 3, or even now 5% interest, your money is depreciating in value. But you always want to have at least 6 months, bare bone minimum, worth of cash sitting there, having some type of creepy crawly forward motion. Step number one. Step number two, move your money to bonds. US government bonds specifically. Bonds are they're still going to take a fall. Right now, government bonds took a decrease because the United States of America, the US citizens have lost faith in the stock market and lost faith in the economy. So when you see that happen, bonds take a dip, and they have. But bonds are still the safest commodity to invest in because you're investing in US utilities and infrastructures and things like that. So what a bond is it's a loan, it's a promissory note. So you give the government your money in exchange for a set interest rate. It might be 3%, 5%. It's not really much, right? But at least you know pretty much that the government is strong most times. But now, yes, even though you have the G fund, thrift savings plans, folk, you're still seeing that depreciation. I'm sorry about that. But it's not as bad as commodities. Commodities on the stock market. So if you're in a thrift savings plan, you're talking about the F fund, you're talking about the C fund, you're talking about the I fund, right? If you have a 401k, you're talking about the S&P 500. You understand what I'm saying? The Russell 2000. Those are the um, um, United States commodities, the United States companies, right? So you're seeing huge decreases in those. So just for the time being, move your money into bonds. Make sure you have at least 6 months worth of savings in the bank. And the next step is to call me and get yourself something called a fixed indexed account or a fixed index annuity, a quick breakdown, and then I'm going to show you what it looks like. Fixed means it has a guaranteed interest rate, so that when the stock market crashes, your money sits on the floor of a guaranteed interest rate. That interest is normally about zero for most of these accounts, 1%. We have an account that has a 1% floor. And then at my firm, I teach our agents how to create a 2 to 3% floor so that when the market crashes, all of our clients have seen just a little bit of growth. This week we've gone back, and even though our clients were sitting in the S&P 500, because we created that 1% floor to 3% floor, every single one of them have earned about 20 or $30 while the market has been down. And when we get on the Zoom call with them, they're like, hey, that's not bad. I guess because they're used to seeing their money grow at nothing in the bank. So they're saying, oh, okay, because my colleagues lost hundreds of thousands of dollars, my money grew a little bit. Then we switched them into global indexes that are outside of the United States. And when we did that, now we have clients that were in those other indexes. They're seeing $1,000 increase in like 2 or 3 months. While one is the bear and the bull, right? The bear pounces on you. So the bear market means that the market is going down. The bull charges forward. So the bull market means the market is going up. So in the United States, it's going down. There's another market that's going up, right? Bear and bull, some kind of balance, right? So we understand those balances, and we can move your money into accounts where it can grow. Okay. So the best thing in the world is to have a trusted financial advisor, a trusted financial coach, a trusted financial expert, such as myself, who has your best interest in mind. And this is the rarity. This is what separates me from the masses. I don't take financial advisors' fees. My fee is referrals. Who do you know that I should know? So in exchange for referrals, I will restructure your account to make sure it grows. That is a rare. And not only that, but I will teach you how to grow your own money. So when you come on a Zoom call with me, you will open up your portal. You will see all the different indexes that you currently have. I'm going to show you, put your money there, 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 and there. And I'm going to show you because of this, because of that, this is doing this, that is doing that. So you are going to get off of the Zoom call with me more financially. Well, how do I put this? Let me make sure I put this in good English. You're going to get off of the Zoom call with me with a greater level of financial literacy, which means you can read. Remember, when you're illiterate, you look at it and you can't read it, right? When you can look at it and actually read it. So you're going to be able to read it, understand it, and do it. It's huge. It's invaluable. And once you have it, nobody can take it away from you. And to do that for you in exchange for referrals, that is a small, small, small price to pay. Remember when those stories when slaves couldn't read and their illiteracy kept them in bondage, kept them in fear? They didn't have the courage to go out and start a business or to even run away because they couldn't read how to get there, right? But when you can read, it gives you the courage to step out on the stock market. It gives you the courage to restructure your retirement plan because you can read and you can know where you're going. So financial literacy, being able to read your retirement account, is one of the greatest skills you can possibly have. Are you picking up what I'm laying down? So that's the first step. Come with me. Let me show you how to read your retirement account so that when this happens, you go, oh, bull bear, let's change. The economy's going right. Let's make this turn left, or let's park it in a safe place, right? And grow your money exponentially. Now, no real financial advisor, nobody who really truly loves you, is a fan of the 401k, 403b, thrift savings plan, or tax deferred plans. Why? Because as soon as you go touch the money, you're creating a tax liability. You're going to owe the IRS 30% or more in taxes any way you cut it, federal, state, and early out penalties. And if you touch it while you're still working, it's a loan from the IRS, which means you're borrowing money you would have paid in taxes from the IRS, and you're creating a tax liability. And it's a variable loan, which means they can charge you what they want, when they want, how they want. They can keep you in debt for years if they so choose. The Bible says the borrower is slave to the lender. They can actually make you a slave if they feel like they need more money at that time. Are you picking up what I'm laying down? So I would strongly encourage you never to borrow money from a thrift savings plan, a 401k, a 403b, or an IRA. Don't borrow your money from the IRS and put yourself, as the Bible says, enslaved to the IRS. Does that sound scary? Good. I want to scare you. Okay. So don't do that. When you're ready to retire, you want to roll and transfer your money into a backdoor Roth. What is that? There's two types of backdoor Roths. There's a traditional backdoor Roth, which is the one that if you went into Charles Schwab or the bank or whatever, they'll tell you pay your taxes. So they'll make you pay a chunk of taxes and then transfer $8,000 or whatever the maximum is per year into a Roth, right? That's not the transfer that rich people do, okay? That's the transfer on a public banking system. Rich people transfer it and never pay taxes. They don't pay taxes. You can do it too. That's the thing. That's the big secret. You can do it too. So you're saying, how, Rochelle? How? Now I need you to come to me and we need to have a private conversation about how. Some of you are my clients and you have 401ks. This account that you have, as long as it's in a 401k, this money is not your money. Don't treat it like it's a bank account and you're just dipping in and out of it. It is not your money. Do you hear what I'm saying to you? 30% to as much as 40% of that money belongs to the IRS. Don't think because it's sitting in an IRA and it's not with your employer, now it's a bank account. And then you're spending it with your eyes, taking vacations, doing this and that like it's your money, because what you're doing is getting yourself in a lot of trouble. You're digging a hole for yourself if you're dipping into that account. And the price comes up due when the IRS sends you a letter saying that we saw you took money out of that IRA and now you owe this huge tax bill. Do you hear what I'm saying? So I don't want to see you in bondage to the IRS. Meditate on that for a minute. Okay. So those of you who already have accounts with me and you know that it's time, your year time is up, you should be seeking me out to do the backdoor Roth. And I can explain to you because it has a lot to do with what state you live in. And there's some moving pieces that we have to plug you into so that you can transfer your money safely and then create a tax-free stream of income. Okay. So there's one more thing I really want to say, and then I'm going to share my little example with you. And I'm going to do this by asking you a question that we should have learned in the 5th grade math class. So go with me for a second. You have a choice to get your money two different ways. Let's say it's time for you to retire, and your employer says you have a choice to take your money two ways. We will give you $500,000 all at once in a lump sum, or we will give you $40,000 in a guaranteed lifetime income. So even if you live until you're 120, you will always get that $40,000 for the rest of your life. Which one of those choices pays the most money? Well, the answer, it depends on your age and your health. If you retire at age 60 and you are in good health, and you live until you're at least 80, which is the average United States life expectancy, you're going to get paid a little over $2 million is what will reach your hand. Do you understand? So you're making a choice between 500,000 and 2 million. But most people let the greed take over. They see the huge chunk of money of 500,000. They'll move it into a brokerage account, which first of all is a mistake, because now that money is at risk of being lost on the stock market. So you're praying and looking and hoping that large pour, you look away and, oh, the market's going to come back. You're hoping and praying. And then that money is just constantly being dwindled down. And then when you need it, you need it for your family, you need it for self-care. You're spending that money down to the line of zero. Wealthy people and wealthy-minded people look at you and say, that's foolish. Only people who don't have financial awareness take a lump sum of money and just ship away with it until it's gone. The wise thing to do is to take that money and create cash flow. Cash flow is the wealthy word for passive income. That means the wise thing to do is to never lose a dime. So the money sits there and is perpetually growing, 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 growing. And you're getting paid dividends. And you're getting paid, or there's a lifetime income benefit rider on it. So this rider is paying you a lifetime income as your lump sum grows and grows and grows. And you're getting paid an income that locks in your lifestyle. So for example, for me and my family, our lifestyle requires $110,000 a year. That is enough to pay all of our bills, our utilities, and take care of 3 adults for us. Okay, it's not the best lifestyle, but we know that that's how much money we need to do everything, and we're good. So a passive income of $110,000 a year makes us financially independent, which means I don't have to work. My mom doesn't have to work. My son doesn't have to work. I don't have to get on any Zoom calls and do anything. But $110,000 a year comes in every single year, and that is enough to take care of all of our bills. We're using that to eliminate debt. We're debt free, so that in the future, it's still, the money doesn't depreciate in value with time. It still holds value, right? So at that point, what's needed is $1.2 million. $1.2 million in one of the accounts that I'm sharing with you will kick out $110,000 for the rest of my life, even if Jesus comes back or not. Right? And then when Jesus comes back, he said, make sure you take care of your family. I can check that box, because anybody who's left behind is still going to get $110,000, because I set it up in this Rockefeller style backdoor Roth. So my generations are taken care of. Are you picking up what I'm laying down? Okay, so the wise thing to do is not to spin down to the line of zero. That's not being your own bank. The wise thing is to set it and forget it and let it pay you a lifetime cash flow. Now, with that being said, I'm going to share my screen with you. Okay, I'm going to show you exactly what I was talking about. I was talking to a friend slash client of mine about this just the other day. She was telling me about real estate investments that she's making and buying vacation property and all kinds of things she was doing. And I said, listen, this is what you need to be financially independent. So her and her husband are business owners. They have a lifestyle that requires, just like myself, $100,000 passive income. So I said, okay, this is your financial independence number. If you can see it, I said, you roll over $1.1 million one time. Now, again, remember the story I told you. You have a choice. What would you do if you had $1 million? Would you take that $1 million, put it in the bank, and then spend it down to the line of zero? Would you take that $1 million and put it out on the stock market and risk that it's lost? Or would you take that $1 million and put it into something that where it always grows and it pays you a passive income? I feel like Jesus right now when he said one servant buried his talent in the ground. So God gave him a talent and the servant just went and buried it. And then when the master came back, that servant just gave him back what he gave him, right? And the other servant went, put the money out there and multiplied the money and gave the master back his money plus 30%. The other servant did the same thing, got a little bit better results and multiplied it 60%. One 30, 60, the other servant 100%. The servant who was afraid and who took his money and just buried it, didn't earn anything on it, the master said to him, you wicked and slothful servant, you know that you're supposed to reap where you have not sown. You should have taken my money and put it through. These are Jesus's words, not mine. These are the Bible words. You should have taken my money and put it to the exchangers. EFT, exchange trading funds, the exchangers, the Lord said, so that I can have back my money plus usury, which is interest. So God is telling us as plain as day, put your money into an exchange. Don't let the cankerworm devour it. Don't let the stock market lose it. Of course, there's a certain portion that you do want to, invest in stock. There's shares and ownership. You do want to be an owner and learn what it means to be an owner. But your retirement money, no. Your bills and emergency funds, no. Once you get your life insurance money, emergency money, no. Okay, that money is separated. The only money that you buy businesses with, that's what you're doing when you're buying shares. The only money you use to buy businesses with is the money that's after the overflow. The overflow is what you buy shares with, not your retirement money, not the financial independence money, not the emergency funds. Okay. So here we go. So we talked to one of my clients about this yesterday. This is our financial independence number, 1.1 million, right? So what do? We put it in a fixed index account. So check a look at this. It has a declared interest rate. So when the market falls, it pays 2.4%. Very good. All right. So that way we know we're not going to look up in there and see negatives where she's lost money because it has a floor. And there's the S&P 500. So that's the top 500 companies in America. Some of these have caps, which means if the S&P 500 did 20%, you wouldn't get that. You would only get 8%. Some of these have participation rates. So here, if the global balance does 10%, you will participate in that market at 140%, which means if the global balance earned 10%, you would earn 14%, right? And then the US fundamental is simply the top 2,000 companies in America, and that has less volatility or less risk. So when the US does come back up, and it will eventually, hopefully, I hope it's not 4 years from now or 3.5 years from now, but it will come back up. It has to, hopefully, right? Then you will earn 140% of that market. There are second year bonuses. So clients of ours who are in their second year and they participated in the market that had 140%, now they're going to be participating at 200%, right? So that's going to do what? Boost their money in the second year. And if the market the S&P 500 comes up again, they'll participate at a cap with a cap of 17%, right? So the caps and the participation rates all go up. There are accounts in here that have broker fees. This is you paying a stockbroker to boost your money. Don't necessarily need that if you have Rochelle Lorraine Dickerson. Because if you have Rochelle Lorraine Dickerson, what I'm going to do is when I see stuff happening in the market, I am going to call you and say, hey, it's time for us to remix this money so that you can make some money, right? So you're going to have me in your pocket that's going to make sure your money is moving forward. But the beautiful thing is it has a floor so that no matter what happens to your money, you're not going to lose a dime. All right. So, okay, Rochelle, I think we get it. So what is the results here? So what we did here was this particular client said, you know what, Rochelle, I'm not going to retire until I'm 65. So I'm going to roll this over, but then I don't have to take it until I'm 65. I said, well, you know what? That's okay because you can take it as soon as you get the rollover. If you take it in a few days after this money hits your account, you're going to take $72,667.50 for the rest of your life. If you wait the next year, you'll take 80,000, 109,000, 119,000. So as you can see, if you waited until you were 70, you take 161,000. So it doesn't matter because you have this rider, you can turn on your income wheresoever you would like. Okay. And this is an annuity. Okay. This is called an income annuity. So what we like to do is if the client says, hey, you know what? I can wait 1 year. So I want you to boost this in 1 year. And we say, cool beans, right? And what we will do is we would roll this over and the company would pay them $110,700 bonus immediately. So I heard this client the other day, she said, Rochelle, who's going to pay us $110,000 and there's no catch? I said, there is a catch. You have to wait 1 year, right? So they'll pay you a 10% bonus. And then this account will say, in this case, it would say $102,500. So immediately it would be 102,000, but you can't touch it for a year, period. You can go, do whatever you want to, but 1 year, hands off. And then after 1 year, we'll boost it, we'll bonus it, and then we'll stick it in the income driver so that all these numbers go exponentially. So if you do have 1 year, that means that to you can take this up to $100,000 after the second year. So we have a strategy that is very unique to us. All right. So we do not participate in market losses. We don't participate at all. At all. Our retirement accounts all have what? A floor. That's your first word in your financial literacy dictionary. It's called a floor. So a floor on an investment account means that when the market falls, your money sits on the floor. So if you're ever watching a CNBC or any kind of financial news, you'll hear them say, what is the floor? What is the floor? They're saying, when does it stop? When does it end? right? And if you're talking about a brokerage account, then you're talking about a guarantee. Guarantee is what you want. Guarantees are what you need on your retirement income. You don't need a retirement account that has no floor. There's no bottom. There's no end. You can lose every single dime if you're not careful because it has what? No floor. You have to have a floor, right? So you want that floor, but you have to have market gains because there's no way on earth to stay ahead of inflation unless you have stock market gains. It's impossible. Inflation runs at 5%. But then when the economy goes wacko, inflation can go up to 10%, 8%. So you'll go in there into the grocery store and eggs that used to be $4 are now $10 a pack, right? So you know that inflation has doubled from 5% to 10%. And if your income and your retirement and your savings aren't growing at that rate, then all of your money, your buying power has decreased. Are you picking up what I'm laying down? So you must have stock market gains. You must have stock market gains in order to keep up with the cost of living. And you must have a floor so that you don't lose any money. Fixed index accounts, in my opinion, are the only place in America where we should all be putting our retirement money. Yes, that's my talk. So I'm going to check my phone to see if anybody has any comments. Right now, I'm just looking into the camera and pouring out my heart. So a fixed index account is what everybody needs. So you're thinking, can I get it at the bank? No, you cannot. Banks are in bed with Wall Street. So the banker, when you go and see that person, they have to be Series 6, Series 7 licensed, which means they must sell you stocks and you must sign a waiver that says you will not sue them or the bank when you lose your money. That's the only option they have because that is their commissions. You're also signing, you don't know it, but you're signing for a broker fee and they'll attach a fee to your account. It's either 1% or 2%. Hopefully, it's not more than that. So that even when you lose your money, you still owe them the fee. So you'll see a decrease from the market and you'll see their fee decrease. And you will owe those jokers just like you owe a bill collector and they're going to get their money. Do you hear what I'm saying? So because they have the broker fees, you cannot go and get an account that has a floor through your bank and credit union. You cannot get it through your job. Same thing. Your job has hired a brokerage house. And whatever the name of that brokerage house is, that brokerage house, they're getting fees even when you lose your money on the stock market. Their fees are guaranteed, and you will owe their fees whether you have money left in your account or not. The only way you can get fixed index accounts, I would hope that you would come to me because I'm the one that's giving you the enlightenment on it. So I would hope that you would call me, text me, message me, email me and say, Rochelle, I want you to show me what you're talking about. Show me what this fixed index account thing is. What is this? Right. So hopefully you would come to me first. But the only way you can get them is through life insurance companies. And there are a couple of investment companies that specialize in them. So you can only get them through companies that specialize in fixed index account. When you go to companies that the majority of their money is from selling you stocks, you're not going to find them. And you might even hear your advisor say, that's no good. Stay away from annuities. They're no good. You hear them dogging it out because they don't get it paid from them. And it's fierce competition. They want your $1 million because when you end up with $400,000 left, you're still going to have to pay them 2% of that account for the rest of your life. which equivalates to $20,000 to $100,000 a year that they're going to collect off of your account. And if you move to a fixed index account, they're not going to get that $20,000 to $100,000 a year in fees out of you. Do you understand what I'm saying? So it is the Wall Street war. But as both a fiduciary and a life insurance agent, I'm telling you to put your money where I put mine and my mama's and my sons and my friends and family. I'm telling you to put your money there so that if the Lord tarries and we make it through what's happening with the government and our administration today, when we see the other side of this, you'll be better off. Okay. So I'm going to look at my cell phone and check to see if anybody wants to chime in. Yep, I'm still live. I'm good. Let's see. Okay. I had a person reschedule today. So that's why I'm on here doing a bunch of talking. Okay. Hi, Ginger. I see you. Hi. Sheila, you're so faithful. Hi. All right. So I'm putting some hearts and likes and I'm saying hello to everybody. Hey, hey, hey. All right. So if you have any questions, go ahead and drop them in the chat right now. And I'm going to keep this up for a little while. These are some of the secrets. So those of you who are coming up on your anniversary date and your clients of mine, you want this money to be tax free, you've got to put it into a trust. And we're going to talk about what trust, what's available in your state, et cetera, et cetera. If you can take it straight on, but you just remember that you're going to be taxed on the growth. Okay. So you need to consider that. And the only way to get Uncle Sam out of your pocket is a couple of ways. And that's some kind of Roth transfer. You understand what I'm saying? So, like that. Okay. So what else? Who else? What else? All right. So for whatever reason, my face is frozen on Facebook. Can y'all see that? It's frozen. And they got this weird expression too. But I know you can hear me. Okay. All right. So I think that's it, y'all. If you're a client of mine, book a call with me and let's reevaluate what's going on. Let me make sure that I've remixed your account so that you're seeing at least $1,000 or more per year, 2,000 or more per year growth on your account. And that way you can brag when everybody else is losing their money on the stock. Like you say, I'm growing my money, right? Look at the growth. And you can say, and you can point straight to the money. Like, I got this much money and that much money and this much money, right? Well, so the stock market crash when? Okay, so the stock market crashed in what? March, April, May, June, July. And then you can say, well, March I earned this much. And so I want you to brag. So that way the people will learn, you know. My people perish because of lack of knowledge. So now you shouldn't perish, and your money perishes because of lack of knowledge too. So apply that to your money as well. You'll say, put your hand on your heart. I want you to receive. My money perishes because of that lack of knowledge. My money grows because of knowledge, right? My money grows because of faith. And even if I don't have the knowledge, God guides me to the people who do have the knowledge and I get good results. Amen. Okay. All right. So like, share, and comment. Go back and rewind this. It's a matter of financial literacy, which means you have to be able to read the terms. What is a floor? What is a bear? What is a bull? What is a put? What is a call? Right? What are common stocks? What is small cap? What are large cap? There's a lot of language there. What is the S&P 500, the Russell 2000? What is the global balance? What is the Hang Seng, right? What are these indexes? What's an EFT? Right? What is an exchange trading fund? What is, so there's a long list of words that we have to know the definition of so that we can be literate. When we see it, we can read it. We can read it. And it is a roadmap to financial success. Financial security is the first layer. Financial independence is the second layer, and financial freedom is the third layer, right? And the goal is to get to financial freedom. But you cannot, this is like the money or the financial underground railroad. You can't get there if you can't read the signs and follow your guides, right? So I'm here so that you can read the signs, so that I'm in it with you, so we can read the signs and get to freedom. Freedom. All right, y'all. I love y'all. I'm sure this was valuable. Go back and rewind it. I'm going to keep it up for a little while, and then I'm going to do what I always do, save it, record it, and then turn it into small videos and bless the entire world. Beloved, I wish above all things that you prosper and be in good health as your soul grows. Is your mind growing? Are you reading and becoming more financially literate? Are you taking care of your mental and physical body and your emotions? Then your money is growing along with that. I love you. Talk to you soon.